Hi guys, I trust you are all well. And I just want to share my screen quickly. Well, it's winter here in Johannesburg, and we are absolutely having a blast of a winter. But all is well. I want to take you through NASDAQ 100 setups that took place yesterday, which I think are quite instructional in terms of how I take trades. But before we do that, I'm in a few trades, which I'm gonna just show you very quickly. Took a trade here, down here, UK 100 sold, wide stop, and the stop was above the, just excuse, there's a helicopter going off the board here. All right, so the stop was just above the 50% pullback. I mean, the high of June, it was a breakout into the leg 2, and also 50% midpoint. So because it was an early trade, and I knew there's always pullbacks. I mean, taking a trade in the Asian session, you must expect deep pullbacks at some stage during the European and UK session, which is what we got. But that's a small risk trade. So that's when I say small risk, that's a third of the capital. So I'm going to add on to it, while we are hanging around here. In a couple of minutes time. In fact, I'll probably just take it at the market so that we can move on. I got a couple of another account I'm trading, so I'm just going to do the same on the other side. Stop is 733.53. So this is just a third risk, 733.53. Just double check my stop. Okay, so I'm just going to sell at the market. So I'm adding on to that trade. So remember that whole thing that I keep telling you guys, everything must be written down. So just add on to that, and then we leave it. Okay, stop is up here. We'll see what happens. I'm also in DAX 30, German 30. So again, took a trade here. At that point, I had my stop measured move of the opening candle. I speak a lot about opening candles. So there's a doji candle, measured move that was there, almost got stopped out, never got stopped out. So that's the actual trade that I took. Now, I also need to just add on to that trade while we edit. Just another look at my working out here. Okay, I want to see a breakout beneath this. So I'm going to wait to see if we get a breakout during the show, pull back, then I can look to add on to that, and stop will be here. Then I can tighten that stop. In fact, while we edit, I'm going to pull my stop down a little bit lower. So stop is almost a break even. I mean, that's fine, because I mean, with that lower high, if the market comes back and takes that, I don't want to be in the trade. So that stop is now, call it 13,111. So I'm going to make sure I do that on the other account that I'm trading. I'll refine it later when we're out of the show. Okay. Why am I not selling here? Because I'm expecting a pullback at that low. It's a wedge bottom, so the market might pull back. I'd rather add in a little bit later on. But if we come back and get stopped, no problem, because we've kind of banked some profit. Euro stocks 50. Again, I need to tighten that stop a little bit. I'm just going to pull it down. Okay, so that stop is now at 3,532. Okay, so I'm just doing that on the other account. 3532, just confirm that 3532. Okay, so stops are tightened quite nicely. Last one that I'm in is Angsen 50. Okay, now I can pull this stop down, two of them, to just, when I say break even, it's a technical point. You see that lower high? So I say you don't just pull stops down to break even, but you got to bring it to a technical point. So that lower high is a technical level, double top, lower high. Okay, so, the market comes back and takes us out, we're not losing anything, capital protected. So just give me a second to do that on the other account. So 2 to 100. Two to 100. Okay, so I will keep an eye on my charts. If we, get any other setup just to add on, I will give you a shout. So what I want to do today is just show you what happened yesterday with NASDAQ, because these things that take place here is exactly the way that we trade all the other charts that appear before us. So if you watched the TTR show on Sunday and saw my little 2.5-minute clip, I spoke about the market still being in a bear trend. And if you haven't watched that, I recommend you go back to the TTR show and watch that. I might, if you don't have the link, I might just put it up if I don't forget. It's, I think I saved it on my YouTube channel. So I mentioned that I think we're still, today is Wednesday, so we still are having that big bull candle that had been created on Friday. And in my show on Sunday, the little video clip, I said, we're still in a bear trend, because sell-off, pullback. Now, NASDAQ 100 is pretty classic in terms of what is showing us, because we're in a bear channel. So this bear channel is prolonged for quite a while. Now, whatever market you trade in, you must always just try and take a longer term view to get a sense of, are we in a trading range, where the key levels of support and resistance, etc. So NASDAQ 100, you can see, and the way you draw your channels, you connect two levels, that high, that lower high, and then you just plonk the lower channel to one of the lower levels. So this could have been there. Okay, you can see how it respected that and that. Alternatively, remember, whenever you see trading ranges, channels, if you just want a bit of clarity, there's absolutely nothing wrong with going to look at the line chart, because the line chart is plotted on closes, and closes are extremely important. So if you plonk it on the close, and if you went back to the candles, you can see how that's how it anchored it on the closes. And the market has respected that. So we're in this huge bear channel. But then the bears got very strong. They created a tighter channel here. They didn't want to wait until they got to the big channel. Having said that, have a look at what happened in February before we had that level created. That's at that point, our channel was like that. And sorry, I had my Zoom widget right over the color blue. So at that point, you'd have had bear breakout beneath the trading range. The reason I really love looking at these chart patterns is that there's this term fractal. Markets are fractal. FRACTAL. All it means that the patterns that you see on any time frame repeat themselves. So as long as you look at charts, 5 minutes, 15 minutes, 20-hour, daily, monthly, the patterns will repeat themselves. So you'd see that on a 5-minute time frame, you see a trading range, you see a breakout, expect a pullback. Okay. Apologies, this should be on silent. Sorry, guys. No, take it. Okay. So the bears created that, but then the bulls got very strong and they broke out of that channel. Okay, fantastic, good for the bulls. But you always look at the actual breakout. That's a breakout candle, doji, follow through, bear candle. So a bit of weakness as far as the bears are concerned, and then the market turned. Okay, and we created the larger channel. The same thing, the reason I'm pointing that the same thing is repeating itself here. Okay, huge bear breakout beneath its trading range, but the bears have created a tighter channel like they created here. Okay, so if we get to the bottom of this channel that they're creating somewhere down here, and then you see the bulls accelerating outside of this, because you've already seen the pattern. Okay, if you trade on the daily, you can take a trade, but your goal, if you're taking a trade down here, is to see if we get to the top of this channel, and if the bulls are strong enough to break above it, and then they want to get up to this channel. Okay, now these horizontal levels are always key. Okay, whether you see them here or you see them on a different time frame. Okay, very key, because look what happened here. If you hadn't drawn this across, you would not have anticipated the market turning here. You'd have been saying, hang on, but why is the market turning here? And you'd have missed an opportunity in this lower high double top to sell beneath this candle. Okay, so it's always important to draw that, because you might break above it and come back somewhere to this level, in which case now we have descending channel line, we have this horizontal level, and you see a reversal like we had here, test and breakout, pullback and lower high, then you look to sell. So we are still in a bear channel. Okay, the bears, their objective is to get down here. That's what they want to do. The bulls, of course, would like to create a double bottom and turn the market, but we are in a strong bear channel. First touch, second touch, there must be a third touch here. Or there must be an attempt to break above this by the bulls, and the bears must try and defend it to just create a third touch, in which case there'll even be a stronger sell-off. So the selling is not yet over as far as these markets are concerned. It might be a little bit of a relief, a bit of a rally like we got here, but it turns again. Now, so we've seen that that's a broad pattern. So when you come to the day, so this was yesterday. Now, most of this, as you will see, took place in the US markets session. So I didn't trade that because I was part of the game and even started with the Asian sessions. But when I had a look at it earlier on today, I thought, wow, what a fantastic instruction, little tool that the guys might benefit from. So we go down to the 5 minute and want to see what unfolds with that day and just point out a few key things. Okay, so it's this day that we want to look at. Let's just make sure everything's all set up. Okay, high of the previous day. Yeah, almost. High of the previous day, there is a low of the previous day. So this would have been the low of Monday. And then that should be the 50% pullback. Let's just verify that. Okay. in the open, that magenta line. Now, the absolute first thing that you always got to look at. It doesn't matter what time you come into the market, but especially and if you're trading this market, you got to be watching as it opens, because everything is important from a price action perspective and everything gives you information. So first candle of the day, very important. I mean, if you're writing notes, you got to look at the first candle of the day. We closed here. The market gapped up. Market gapping up, which means the bulls were strong overnight or over the time the market was closed. So if the bulls were strong after the gap up, we need a bull candle to own the opening of the day. But the fact is we had a huge bear candle after the gap up, a bear trend candle, which means just a big body, small tails. Okay. So the bulls were not as strong as they would have wanted to demonstrate. They were strong enough to gap it up, but the bears came in with such force that they turned the market immediately. Big bear candle, so you expect a lot of selling today. But after that first candle, when I see the second candle, then you say, hang on a second. The bears were strong to reverse the market, but why do we have a weak follow through? Why do we have a dodgy? Why didn't they give us another strong bear candle? Then we know we're anticipating a bear trend from the open. And if we're anticipating a bear trend from the open, we just need a pullback and we can look to trade it. So we didn't get that at the open. So that presents a bit of a challenge. Now, some guys, I don't do that, want to trade the first candle. I just want confirmation. If you want to trade the first candle and say, oh, strong bears, I'm expecting bear selling today, you can sell at the close, but at the minimum, your stop must be a measured move or slightly above. You always do that on the first candle. Well, not you always. I always do that if I'm taking a trade at the open. Now, for me, it won't be the first candle to be. Possibly the first candle. If I see the second candle and I get confirmation the bears are strong, then I'm going to take that trade. I have to see the second candle. Okay. Then I can put my stop above there. If it goes back, usually it won't get a measured move. Might give you a chance to add on to your trade. Now, the only way you can do that is if on the first trade itself, you don't take the full risk, right? If you trade in 1%, if you put the full 1%, there's nothing more you can do. You can just wait and see what happens. But I like to break up my trades and put 1/3% in, especially in these early reversal trades, or I can put half. If it pulls back against me, I'm not stopped out, I can put the other 1/3 in. Still well within my risk that I have per each market. So that tells you now the bears are strong. They've been repulsed, a bit of a follow through. So I'm expecting a bit of trading range price action. Why? Because of that second candle. If they've given us a strong candle, then we're expecting a bear trend. In any case, market came back, didn't get to the measured move. Well, tested the measured move of the first candle. And now you're trying to say, okay, bears were strong enough on the open. No, let's start with that. But they failed to capitalize. They created a lower high. Bulls have broken above that lower high. Really, the bulls, the expectation is to get to a measured move, that high, that low. And they go to the measured move, and there was no way, just based on this, they were on initial attempt going to get above the first measured move. Okay, so if you didn't take that trade, if you saw lower highs here and decided you wanted to take the trade, you're still on the measured move, stop. If you didn't do that, you say, okay, bulls reached their objective, no follow through, inside candle. Let me find ways to get into the market, breakout, pull back. There's a trade you could get into the market. There's another trade you could get into the market. You are still taking reversal trades, and you always wonder, where do I put my stop? Well, you have that measured move. That's an area you could put your stop. Alternatively, you could say, I'm taking the trade here, I'm taking the trade there. Measured move about around above that is just slightly above there. Fantastic, you can still put it there. Then you'd have taken that trade. Now, the point with this is that if you don't get clarity when you start looking at the market, it is always best to wait. Okay, rather wait, because the things will get clearer and clearer. And I know the feeling is sitting there and saying, oh man, I should have taken that trade, and watching it go, it might just accelerate down. Rather have that feeling of I should have taken that trade than to rush it. Because you rush it and it goes against you, then you say, oh man, I should have waited. You know, wait for clarity. When you get clarity, then you can take a trade. Okay. So you would have taken that trade and you'd have said, well, how far do the bears want to take this? Present trading range, that high, that low. If we break out beneath that, that's a measured move. Now, this measured move are extremely powerful. I think by now, we all kind of getting the sense, having a quick look at my trades. Oh, well, still no way for us to add on a little bit more, but that's not bad, that's good. So measured moves are ultimately powerful because when you see these pullbacks, it's not a surprise. They tend to take place at some measured move. Okay, so there is, I mean, if you're sitting at home and looking at charts and trying to educate yourself, I really recommend you work with these measured moves. Even if you print your charts out, just use a ruler, one line there, and see how far it goes. Okay, so no surprise that we got here. Could also have said, well, there's a little breakout there. Okay, breaking out beneath that, and there's the end. So that's a measured move. So a huge bear candle, but the market didn't turn here. So we had acceleration down, but we're turning here. Okay, when you see this acceleration down and the turn at the measured move, and then you get a 2-bar reversal like that, you're gonna be thinking, oh, there must be a little bit more left to this market. Let me see, where's the breakout point? So look at the bear bodies. And the breakout point is straight, that low. So the market, so we look at where the market broke out. Here we say there is a breakout point. So there is a breakout point. Market broke out beneath here and then pull back. So the measured move of the actual breakout from here to there is there. Okay, so you can take that trade comfortably for a 1-to-1. Another reason you could do that, because now it's a trend trade, right? It's no longer a reversal trade. And I'll explain something about that. So first leg is something you always look at as well. There is the first leg. There is a pullback. So the first leg from where it started to where the pullback started, and there is a measured move. Perfect. And that's a perfect landing right there. Now, when we say reversal trades, like here, we're looking, we're saying there's a higher probability of the market going in our direction. Well, having a quick look at those trades while we edit, let's go back. Edit on here, so that one's fine. I'm gonna wait, I'll move the stop a little bit later to there. German 30, we decided not to take one here. We said breakout. So I'm going to stay in that trade, breakout. If I see a pullback forming, then I'm very happy to add on to the trade. I mean, this trade is almost a break even, so no harm in adding on to that. Euro stocks 50. What I'm going to do here, I'm just going to pull the stop down to just almost break even. So I'm removing all the risk. Now I'm saying almost, there's a lower high there. That's what I'm using. 3526, so I just need to make the adjustment on the other account. 352. Okay, so that's in a nice space. I'll be able to look at it and see if I can add on to those trades. I think I'll do that shortly. Hang Seng 50. Okay, fantastic. I'm just going to let it go a little bit and I'll tighten the stop. But so all the trades virtually are in break even and good profits. So we're just going to let them run for now. All right. So when I say reversal trades, remember reversal trades, 40% chance of success that if you sell anywhere in here, it's going to go your way. The other 60% does not mean you lose. It means market can go into a trading range most likely, which means you can manage it. If it just goes in a trading range, you can tighten your stops and not get stopped out. Okay, or get stopped out but with minimal loss. Or it might reverse against you. But once we have a breakout, although when we have a pullback, this is technically a reversal back into trend, but it's a breakout now. There's less profit left in the trade than there would have been if we were to take the trade up here. So when you're taking this trade, you're going for a one-to-one return, which is fantastic. Put your entry here, stop up there, one-to-one, easy bank. I mean, literally 1, 2, 3, 4. Well, this one is already given the signal, 1, 2, 3, in 15 minutes, 3 candles. You get your one-to-one, and that's it. You get 1% banked, and you don't have to work any further. It could be a little bit more because you could always look and say, okay, there is a breakout. The actual breakout is here or there. So you could put a stop at the breakout, 50% breakout. Okay, above there, because you say, no, if I take a trade and they stop me out, I don't want to be in the trade. Now, if you're going to do that, all you must, your risk is still up here. Okay, that's where your correct stop will have been, but you tighten it to there. So if you're risking 1%, if you put your entry about there, you've only got 1/3 risked. So that if it turns against you, don't lose the full 1%, just get 1/3 out. So don't work out the 1% on that. This is just to keep a tighter stop at a technical level in the market. Now, whether you've taken a trade or not, excuse me, this is important. Everything is important. Measured move reached, pullback. Leg 1, leg 2 reached. Decent enough reversal. Okay, you have a choice. If you were in a bear trade, it's very difficult, at least from my experience, to jump into to get stopped out here or to take your profits, then immediately be computing with a calculator and working out, you know, how much entry should I have. Maybe if you're using one of these automated robots and stuff, if you can do that, possibly will be quick enough. But as a price action trader, I work everything out manually and I like it. I probably won't be able to take that. Okay, if I'd not been in a trade and I've been watching all of that and I've missed all of that, when I see that, then I'll say happiness, I can take that trade. Measured move of that signal, put the stop here in case the market wants to do a third move down. Okay. If you miss that, still no problem. Say, okay, there's a reversal. We come back above the low of yesterday, which was we broke through a level of support. Market turned, broke above it. So now broke through level of support. That support became resistance here, broke above the resistance level. Bulls closed above the 10 EMA. We want to see if the bulls are strong enough to give us a full candle that's above the 20 EMA. Okay, that's where the 20 EMA is quite powerful. That's a moving average gap bar. We then have that. So the bulls are strong enough. After all of this sell-off, where everything was beneath the 10 EMA, finally they're strong enough to close above the 10 EMA to give us a full candle above the 20 EMA. So it's a bear candle, but the bulls push the market up. Now, if you are a bear, you're probably saying, okay, as long as we are beneath this low high and that 50%, I am looking to sell. So bears could be saying, okay, I see all of that, but I think the bears are strong in the market. Now, if you are a bear, before you sell again, you want to see the bears close beneath the moving average. Okay, when they have strength to close beneath the moving average with follow through, then you can look for a lower high. Okay, so they're broken beneath that, you look for a lower high, right? So this is one of those classic patterns. Market's gone up 1, 2, 3 times, 1, 2, 3 times, fantastic. Let me see a breakout, let me see a lower high. But we don't get a lower high. In fact, we get a decent enough 2-bar reversal by the bulls, double top, and we come back and we close it above at the EMAs. So because we don't get that as a bear, you should not be selling at all at this stage. If you're selling here, you could have a wide stop and there's no point in doing that. Okay, so decent enough reversal. Bulls can jump in, but if you jump in there's a bull, your stop is going to be down here. Okay, because of this level. So bears would not have, in any case, if you decided to jump in and you see all of that, you need to get out. But bears should not be jumping in at all. The only opportunity for bulls to get in would have been here or here. Okay, if you're taking a trade here at levels of resistance, I mean, you got a wide stop. It's better to wait and see if the market comes back again. Eventually, we do get a bull breakout here, breakout candle, follow through, market goes sideways, a little triangle here, which is breakout mode, converging triangle. So kind of get a sense, everything that we look at is important, nothing is unimportant. Why is that important? Because it's an attempt by the bears to make the market fail. Breakout mode means we expect market to have a breakout up or down, and that breakout to fail. So try to break out, they fail, but then the bulls came back again. But that is something that you must keep in mind to see if at any point later on we have a failure. But we don't have big candle, follow through, and then above. I'm going to put this here at this point. Okay, that was our measured move. But at this point, it's always important to mark that was the high of the day at that point. Let's give it a color. So that point, that was the high of today. Okay, high of that trading range. And you've seen all of this strength. That's good. Breakout, follow through. So we're breaking out above this breakout mode pattern and follow through. But this does not mean that the bulls have taken over the market, because we're still well within the original high of the day. So if the bears had turned the market right here, you'd have said, oh, okay, double top. Isn't that fantastic? Double top. So let me see if I get a lower high. So these two big bull candles are just the market rushing to test the high of the day. That's all that is. That's a rush to test the high of the day. Then you want to say, okay, at the high of the day, how strong are the bulls? The bulls really are strong. They are now going to give us a breakout candle. and a follow-through candle above what was the high of the day, high of today at that point. Look what we get. They attempt to break tail. They have a huge bear candle. At some point, that candle was up there, and that candle came to the 50% midpoint of the range of yesterday. Now that's going to be giving you some really bright alarms and alerts in your brain, because firstly, if the bulls are strong, they have to close at the high of the breakout candle. This is the breakout candle. Then they need to give us a follow-through. And we say, oh, the bulls were strong enough to break above the high of the day then, and to give us a follow-through candle. Okay, but they didn't. They got to test 50% midpoint, which is very important, the full range of yesterday. Half of it determines who is going to be in control today. So the market has come up to the 50% point. The bears who were not in the market are going to defend that position strongly. It's like when there's a red news announcement, I think there's a couple of news announcements today, if I'm correct, or tomorrow. When you see that huge breakout candle, if it closes on here, it's extreme in terms of low for the bears or high for the bulls. You don't have to sell, to buy at the top or sell at the bottom. Wait to see if that 50% pullback is going to be defended. So the 50% pullback, that midpoint of yesterday, is very important. Now, if we go back, this is why this is so important, to that first candle. The bears control the day, control the opening candle. If these bears that control this opening candle are very strong, they did that for us. Okay, bulls came back. But if those bears are strong, the last-ditch effort for them to show their strength is to control the 50% midpoint. So hence, you can see when the market gets to this level, there's a lot of selling taking place. Huge bull candle at some point, sell off. So it doesn't matter, you're still thinking short. Maybe, you're not at home or you're at work, whatever, and you see all of this. Say, I'm still thinking short, but how do I get in? You don't have to get in here. You wait, and then when you see the market coming to this 50%, that's why you always mark high of yesterday, low of yesterday, 50% midpoint, and then that measure move extension of the day, because very important. So now you can say, okay, there might be an opportunity for me to jump to the market. Now, guess what is also created here? The same pattern that we had there. Breakout mode, converging triangle, and converging triangle is simply inside pattern, inside pattern. Okay, it's breakout mode. The market is not going to just shrink forever. There will be an opportunity to break out. At this point here, when we had that pattern, bulls were the first to break out, failed. We came back to the apex, the middle of the breakout mode, but then they came back and controlled the breakout. Here, 1, 2, 3. So here again, 1, 2, 3, 3 inside candles. 1, 2, 3, 3 inside candles. That one there. First attempt to break out is by the bears, and we expect a breakout to fail. Failed breakout, come back to the apex. Bears came back again to control. So the breakout of that pattern is controlled by the bears, whereas the breakout of this pattern was controlled by the bulls, who then failed at that 50% pullback. So when you see that, this is where it starts to get interesting. You kind of going to say, okay, remember, this is unfolding before you, and you decide whether to take a trade for all of this has taken place. Do I take a trade here? And if I do, where do I put my stop? Well, have a quick look. The highest point we had was the high of today, which we broke above, and we failed at the 50% pullback. We have a trading range that's coming out of this candle. Then if we do a measured move of that whole trading range, so the measured move is here, you're saying, if this breakout mode fails, and if the bulls come back which they can with a pullback, the market may likely go up to test that. So I can just put my stop above here and whatever, put a third risk, half, because you're taking a reversal trade. Do your best not to put the full risk on. When the market starts to accelerate and go down, then you can look at that. So you could take a trade anywhere here. If you didn't take that and you're waiting for a little bit more confirmation, there's a little bit of a wedge pattern. The market went up once, twice, 3 times. You take a trade there, again, still the same stop. And then you just gotta wait. And it goes sideways. Now, I wanted to point out, market went sideways quite a bit here. Now, all of this took how many hours? 9, 10, up to 16. That's like 7 hours. That's like a whole day of the market going sideways, sideways, sideways. But you're still holding with your stop sideways, sideways, sideways. Then at the open of the US markets, we have this huge bull candle that would have stopped us out right there. Now, when you get stopped out, because you're taking a reversal trade, small risk, or even if you've put the full risk, it doesn't matter. Your thesis is still the same. The bulls have tried to break out finally above the 50% point, tried to break out and they failed. And again, we have this breakout mode pattern created here. Okay, so you're looking at that and say, okay, I've been stopped out. The bulls are strong, they're going to accelerate up, but they failed to accelerate up. We have another breakout mode pattern. Bears tried to break out, failed, we get an inside candle. You have to take a trade. Okay, and goes again to the point, where do I take the trade? Where do I put my stop? Repeat the whole thing again, measured move. Now it's a little bit higher, and your stop is above the high of the day based on the measured move. You take the trade there, and then you get rewarded. Get rewarded all the way down for the rest of the day. Now, within here, you could take out, take some breakout pullback trades here, trades there. So you really could make some decent money. You would have been stopped out here once if you'd taken your first trade there. Now, depending how you work, if you've been in and out of the market, you'd have been able to be rewarded there. Now, the point of this is just to show you that there are huge opportunities in the market, but also if you're holding on to a thesis that today we're going to sell off, and you see in the Asian session, you see that first candle, you see the opportunities, take the trades. If you're not in the market on the day and you see all of this and you get up here, you have to take the trades, manage your capital. You get stopped out, fantastic, you can come out. But alternatively, if you trade the trading range, there's many other ways here. Come out here with the big candle, sell again, trading range. So you could have taken a few other trading range trades within here and made money, but I just focused on the key reversal trades. All right, guys, so happiness, quick look at our trades. UK 100 is still fine. German 30 is fine. I'm going to look to add in here just now as we are done. Bring my stop down. It's already a break even, but now I want to add a little bit more to that trade. Euro stocks 50, again, fantastic, stop a break. Need to see a little bit more selling, but I'm going to be adding again to that. I'm saying 50, not yet adding to that, but I'll tighten my stop. I need a little bit more acceleration. I tighten the stop, but all are in positive. All right, guys, take care. We will see you next week. I hope you enjoy the session. Thank you very much, Marlon. Take care, guys. We will see you again soon.